company can report its best year in history and still fail the one number that decides whether it belongs in a retirement portfolio. SGX just did exactly that. Record profit, a 52% bigger dividend, and an institutional analyst raising its earnings forecast. And the rating on the table is still hold, not buy. UOB Kay Hian's own numbers show why a target price of $23.40 and a hold rating are not in conflict. I run every stock through the same forensic screen regardless of how good the headline looks, because a strong business and a fairly priced income stream are two different questions. SGX's full year 2026 results answer the first question emphatically. What they don't answer is whether today's price pays you enough to hold it for retirement income. Let's look at what the analyst actually said before we get to what our screen found. UOB Kay Hian's note on the Singapore Exchange is unambiguously positive on the business. Full year 2026 net profit came in at 698.4 million Singapore dollars, up 7.8% year-on-year, while UOB Kay Hian's own adjusted core net profit measure showed 759.5 million Singapore dollars, up 24.6% and beating their own forecast by 2.8%. Net revenue rose 13.9% to 1.48 billion Singapore dollars, with fixed income, currencies and commodities revenue up 17%. Cash equities up a striking 28.1% and platform services up 7%. The one soft spot, equity derivatives, dipped just 0.4%, barely worth mentioning against everything else. Cost discipline stood out as a genuine positive. Adjusted operating expenses rose only 5.5% against 13.9% revenue growth, pushing core operating margin up 3.1 percentage points to 61.3%. That's the kind of operating leverage that makes analysts raise numbers. And UOB Kay Hian did exactly that, lifting full year 2027 and 2028 earnings forecasts by 4 to 5% to 860 million and 896 million Singapore dollars respectively, with full year 2027 core earnings projected to grow 13.2%. Trading activity was broad-based rather than concentrated in one product line. Securities daily average value rose 34.9% to 1.8 billion Singapore dollars. Fixed income, currencies and commodities contract volume grew 26% and equity derivatives volume grew 6.4%. The report attributes this to stronger investor flows into Singapore equities and rising demand across the exchange's currency, commodity and index derivative suite. Looking forward, UOB Kay Hian points to a roughly 50-deal initial public offering pipeline, market structure reforms, and expansion into foreign exchange, commodities over-the-counter clearing, and gold-related products as continued growth drivers, with management reiterating 6 to 8% medium-term revenue growth guidance. None of this is in dispute. UOB Kay Hian isn't questioning the operational trajectory anywhere in this note. Here is the load-bearing assumption behind the hold rating. It rests entirely on valuation, not operations. The stock trades at a projected 29 times forward earnings for full year 2028, above global exchange peers at roughly 20 to 26 times. UOB Kay Hian's own target price is built on 27.9 times full year 2028 earnings. A multiple the firm itself notes sits 2 standard deviations above the 5-year historical average of 22.5 times. The analyst isn't disputing the business. The analyst is saying the price already assumes a lot of the good news has arrived. Our framework runs a parallel test, independent of any analyst's price target. Does this stock's actual yield clear the bar a retiree needs it to clear? For SGX, the answer isn't close. At a share price of $24.51, the confirmed full year 2026 total dividend of 57 cents per share produces a trailing yield of 2.33%. Strip out the 12.5-cent one-off capital recycling dividend, since that's explicitly a non-recurring distribution tied to a specific corporate action rather than an ongoing payout commitment, and the ordinary-only yield falls to 1.82%. Both figures sit meaningfully below our 3.2% forensic floor, the deliberately conservative baseline every stock in our coverage is tested against before we even reach the 4.7% minimum hurdle for retirement income. This isn't a narrow miss on an aggressive target, it's a floor breach on either basis you choose to compute it. Let's review the complete financial health checklist. Total trailing yield sits at 2.33% against the 3.2% floor, a fail. Ordinary-only yield sits at 1.82%, also a fail against that same floor. Debt to equity on a gross basis is 28.6%. Comfortably below the 35% ceiling, a pass. Net cash position stands at 1.56 billion Singapore dollars, a clear structural strength. Interest coverage isn't meaningfully applicable here, since the company runs net interest income rather than net interest expense. Current price to earnings sits around 34.5 times against a peer range of roughly 20 to 26 times, a genuine watch item. Here's where SGX genuinely earns its reputation as a fortress balance sheet, and where our screen agrees with UOB Kay Hian's own framing. Gearing sits comfortably under any reasonable ceiling at 28.6% debt to equity. More strikingly, the company carries 1.56 billion Singapore dollars in net cash, meaning it holds meaningfully more cash and short-term investments than it owes in interest-bearing debt. Interest income of 41.6 million Singapore dollars actually exceeds interest expense of 16.6 million Singapore dollars, producing $25 million in net interest income for the year. This is a company earning money on its own balance sheet position, not straining to service debt. One single clean cause drives this entire verdict. The price doesn't generate enough yield. This is not a compound failure. Tracking the dividend trajectory over recent periods explains the trailing window mechanics clearly. In full year 2025, the total dividend was 37.5 cents. For full year 2026, the board declared a 10.75 cent first quarter dividend, an 11 cent second quarter interim dividend, an 11.5 cent final ordinary dividend, and a 12.5 cent one-off additional dividend, bringing the full year total to 57 cents. The quarterly ordinary rate itself was genuinely raised from 10.5 cents to 11.5 cents, a real recurring increase built on the back of record operating performance. The trajectory tells a genuinely positive story on the ordinary dividend side. That's not the part our screen is flagging. The part worth watching closely is the composition of the 57-cent headline total, roughly 22% of this year's total distribution. The 12.5-cent one-off is explicitly attributed to capital recycling gains, a specific named one-time event rather than an ongoing distribution policy. Annualizing the new ordinary quarterly rate alone, 11.5 cents times 4 produces 46 cents. Well short of the 57-cent headline once that one-off rolls out of next year's comparison base. A reader anchoring on the 57-cent figure or on the 52% year-over-year increase headline is measuring against a number that has a real chance of not repeating at the same scale next year. Investing Pro's own blended fair value model puts fair value at $20.01 against the current share price of $24.51, a gap of roughly 18.4% downside, with the model's own uncertainty rating logged as low. That's not a fringe estimate on the margins of the valuation range. It sits inside Investing Pro's own fair value spread of $17.30 to $25.15 closer to the bottom. Two independent tools, an institutional sell-side analyst and a quantitative fair value model, are converging on the same read from different directions. UOB Kay Hian's price target implies a 27.9 times full year 2028 multiple, itself 2 standard deviations above the 5-year average. Investing Pro's fair value sits nearly a fifth below the current price. Neither source disputes that this is a genuinely well-run, well-capitalized business having its best year on record. Both are independently flagging that the price has already absorbed most of that good news, and possibly then some. When a forensic yield floor breach, an analyst's own valuation ceiling, and a quantitative fair value gap all point the same direction, that's not 3 separate concerns. It's one concern, confirmed 3 times. This channel is a passion project, not an income source. No sponsors, no affiliate links, no subscriber count to protect. A Zone 5 verdict stays a Zone 5 verdict even when the stock is 1/2 of Singapore holds. Get everything, 0-day access on both platforms, full red zone watchlist, institutional grade cheat sheets with Iggy's elite investors, 12 Singapore dollars a month. The clearest resolution path is a genuine ordinary dividend increase large enough to close the yield gap without relying on further one-off distributions, since a repeat of this year's capital recycling gain isn't something the company has committed to as policy. A meaningful share price correction toward Investing Pro's fair value range would also mechanically improve the yield without requiring any change in payout. Investors should also watch whether the roughly 50-deal initial public offering pipeline UOB Kay Hian references actually converts into listings, since that pipeline underpins a meaningful share of the medium-term earnings growth story both the analyst and the underlying operating momentum currently assume. Nothing in this screen is a bet against the business quality. Record profit, expanding margins, a net cash balance sheet, and a genuinely broad-based revenue mix are all real and all positive. The question our framework asks is narrower and less flattering to the price. Does today's entry point pay a retiree enough cash yield to justify holding it for income? Once a government-guaranteed 4% alternative exists in the same currency with none of the market risk, at 1.82 to 2.33%, the honest answer is no, not yet, regardless of how good the underlying company is. If you've held this stock for years, this year's results and dividend increase are genuinely good news for you. Your yield on cost from an earlier entry price likely tells a very different story than the 1.82% a fresh buyer gets today, and the underlying business has never looked stronger. If you're deploying new capital, the calculation is separate. You're buying into a fortress balance sheet at a rich multiple for a cash yield well below what the Central Provident Fund special account pays you with zero market risk. Both readers are looking at the same company. Neither is wrong about what they're seeing. They're just seeing it from different sides of the entry price. If you've held this stock for years, this year's results and dividend increase are genuinely good news for you. Your yield on cost from an earlier entry price likely tells a very different story than the 1.82% a fresh buyer gets today. And the underlying business has never looked stronger. If you're deploying new capital, the calculation is separate. You're buying into a fortress balance sheet at a rich multiple for a cash yield well below what the Central Provident Fund special account pays you with zero market risk. Both readers are looking at the same company. Neither is wrong about what they're seeing. They're just seeing it from different sides of the entry price. 698 million Singapore dollars in full year 2026 net profit, up 7.8% year on year. A total dividend of 57 cents, including the 12.5-cent one-off. An ordinary yield of 1.82% against our 3.2% floor. And a net cash position of 1.56 billion Singapore dollars, underscoring the fortress balance sheet underneath all of it. The gap here is not subtle. Even the total yield, including the non-recurring 12.5-cent one-off, falls short of the forensic floor by nearly a full percentage point. The ordinary-only yield sits closer to the Central Provident Fund's risk-free rate than to our minimum retirement income hurdle. Great business. Record profit, expanding margins, net cash, and a broad revenue mix, all real, all positive, rich price, roughly 34.5 times earnings, 2 standard deviations above the historical average, and about 18% above Investing Pro's fair value. Yield fails the floor. 1.82 to 2.33% does not clear our 3.2% forensic floor or the 4.7% retirement hurdle. Iggy's forensic zone, Zone 5, red zone, structural yield floor breach. This is not a timing call. This is not a business quality call. This is a price call. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a MAFS licensed financial advisor before committing funds.